Welcome to episode 2 of the NFMW series, where we help you to understand the two-part system. In this episode, we will continue the conversation around seed capital and the impact of making early savings withdrawals. But first, let's recap. In our last episode, we explained how the two-part system that will come into effect on 1 September 2024 will work. Your retirement savings fund credit will be divided into 3 pots. The vested pot holds all the savings you accumulate up to 31 August 2024. No further contributions will be made to this pot. Then there's the savings pot. From 1 September 2024, 1/3 of the monthly contributions will go here. Remember, this pot is accessible once every tax year for emergencies, but beware of the tax implications and the impact on your retirement savings. Lastly, the retirement pot. This is where the bulk of the contributions, 2/3, will go. It is only accessible upon retirement to provide an income. We also talked about seed capital. On 1 September 2024, 10% of your total savings will be made available in your savings pot, with a maximum limit of 30,000 Rand. You can access this money if you need to. Making annual savings withdrawals comes with its own set of implications. You will be taxed at your marginal tax rate, and you can potentially be pushed into a higher tax bracket. Plus, there are administration costs, and most importantly, the impact on your retirement savings to consider. Let's look at the tax implications of making savings withdrawals. We'll use the following example to explain. Meet Edna. She's an employee at Emalahleni Municipality and will have saved 400,000 Rand by 31 August 2024. 30,000 Rand of that amount will be made available to her as seed capital in her savings pot. She intends to withdraw the 30,000 Rand seed capital to use as a deposit on a new car. Edna's annual taxable income is 237,000 Rand, with a marginal tax rate of 18%. She will therefore have a tax deduction of 18% on her 30,000 Rand savings withdrawal, which amounts to 5,400 Rand payable in tax. 30,000 Rand less 5,400 Rand, 18% tax, equals 24,600 Rand payable to Edna. Now, here's where it gets a bit tricky. The savings withdrawal of 30,000 Rand is regarded as an extra income Edna received for the tax year, which raises her total annual taxable income from 237,000 to 264,000 Rand, moving her into a higher tax bracket. By withdrawing the 30,000 Rand from her savings pot, Edna has an immediate 18% tax deduction of 5,400 Rand. The withdrawal also increases her total taxable income for the year, potentially resulting in additional income tax owed to SARS at the end of the tax year. Remember, you will be taxed at your marginal tax rate on any withdrawals made from your savings pot. The higher your income, the higher the tax payable. Now let's look at the long-term impact of savings withdrawals on your retirement outcome using the following example. 2 friends, Bongi and Noma, both 35 years old, earn the same salary of 200,000 Rand per annum and make a combined total of 25% in member and employer contributions each month. They have identical savings but different mindsets. On 31 August 2024, they each have 300,000 Rand in their vested pots. And on 1st September, 30,000 Rand of these funds becomes available as seed capital in their savings pots to withdraw. Bongi is a planner. He's thinking about his future and wants to make sure he's set for retirement. When the two-pot system kicks in, Bongi stays disciplined. He does not withdraw any of the money in his savings pot. Norma, on the other hand, loves to live in the moment. When the 30,000 Rand seed capital is transferred into her savings pot, she immediately starts dreaming about a trip to Thailand. She chooses to take the money out of her savings pot and book the holiday. Over the next 30 years, Bongi stays focused on his goal. He doesn't touch the money in his savings pot, letting it grow until he reaches retirement age. Noma, however, is a different story. Every year, she finds reasons to dip into her savings pot. Whether it's for a new car, shopping sprees, or holidays, she sees these as emergency expenses and uses up all the money in her savings pot. Noma is taxed on every withdrawal she makes. 30 years later, both are now 65 and having to retire. Bongi and Noma have similar outcomes in their vested and retirement pots, but their savings pots differ significantly. Vested pots had a balance of 270,000 Rand on 31 August 2024 and earned an annual investment return of 8%. There were no further contributions made. The total savings in each of their vested pots is 2,716,917, which is payable in accordance with the fund rules that apply before 1 September 2024. Retirement pots received contributions amounting to 2,651,227 over the 30-year period, earning an 8% annual investment return. 7,506,882 Rand is available in both Bongi and Noma's retirement pots to make provision for them to receive a monthly income. Now let's look at their savings pots. Bongi's savings pot had an opening balance of 30,000 Rand seed capital on 1st September 2024, which he did not withdraw. Contributions amounting to 1,325,614 were made over 30 years, earning an 8% annual investment return. Bongi has 4,055,321 Rand available to withdraw as a cash lump sum. Noma savings pot. Noma immediately withdrew the 30,000 Rand seed capital. Contributions amounting to 1,325,614 were also made over 30 years, which Noma withdrew every tax year. Noma has no more money left in her savings pot to withdraw as a cash lump sum. Noma ended up with 4 million Rand less in retirement savings than Bongi. Here's why. Annual withdrawals. Noma withdrew all the money in her savings pot every year for 30 years, while Bongi left his savings untouched until retirement. The long-term impact. Noma's focus on immediate gratification led to a big gap in retirement savings. Bongi's discipline allowed him to build a substantial nest egg. Missed investment growth. Noma missed out on investment returns over 30 years, whilst Bongi's savings pot grew with contributions and investment returns, and he benefited from compound interest. Noma's experience warns us about the dangers of spending money too quickly on things we want right now without thinking about the future. Bongi's story teaches us that by putting aside money consistently and being patient, we can grow our wealth over time. Remember, it's about securing your future one pot at a time. Join us next time when we look at the benefits payable to you when you end service, i.e. resign or retire under the new two-pot system. Have you registered for online access yet? This will allow you to submit automated withdrawal applications online from 1st September 2024. Remember, the money will not be available immediately. The fund needs to verify details like your bank information, and there will be deductions for tax and administration costs before the balance is paid to you. Register now by scanning the QR code, downloading the free Sanlam Portfolio application, or by visiting the fund's website at www.nationalfund.co.za and clicking on the Login button. Connect with us. Call us toll-free on 080-112-2884. Send us an email to info@nationalfund.co.za. Like us on Facebook and follow us on LinkedIn, or message us via WhatsApp on 066 283 7712. Remember, we're here to help you. NFNW, the fund of choice in local government.